Welcome to this lecture. My name is Mark Smadek. I'm Associate Dean of the Business School, and it's my honor to welcome you on behalf of the Business School and on behalf of the University of Leeds. This is an FT Masterclass lecture. Just for housekeeping, we've got some emergency exits on both sides. We don't expect anything. So if the alarm does go off, we have to react and respond and go outside. And the assembly area is just outside here, next to the sports hall. The Financial Times lecture series has been going for about 7 years now, 7 academic years. And in that time, the Business School, University of Leeds, has doubled in size and developed many new programs and research tracks in our business school. We are a research-focused faculty, so we do a lot of research with more than 120 research active staff now, and nearly half of those come from outside the UK. And our interest is in many different areas, but it includes finance and economics, and also how businesses are funded. And that means that that's also, in terms of private equity, a regular topic of research. So we, for example, have looked into issues around credit for businesses in the region. We looked at private equity in the UK market, the European market, but also in China, for example. We've done interesting work on behavioral aspects of how to pitch in front of investors and see how effective body language and metaphors are in that environment. And so our colleagues in the business school and other areas of the university have a very strong interest in private equity and the development of business. We also have an interest in developing businesses in the region, and so some of our work, particularly with Goldman Sachs over the last few years in developing leadership in growth businesses, has been very successful and has helped us to start this in the UK. And so I think that what we're trying to do, hopefully, is to build some of the companies that Jason then can invest in the future. It's very fitting for us to host you, Jason, not just because you are a prominent figure in the private equity industry, but also because you are an alumnus of the university, and so is Kate, your wife. So we're very honored to have you back here on campus. We understand that it has changed a little bit, and he just told me that you all look very much smarter than you did in days gone by. So Jason actually has worked for 20 years in the private equity industry, first with 3i, and now with Montagu, where he's a chief executive. And we've been really looking forward to hear him come back and speak about the private equity industry on the back of his experience. So thank you very much, and the floor is yours. And afterwards we'll have some questions and answers, and then we'll go for some drinks in the foyer. Thank you, Jason.
Thank you, Mark. So a few weeks ago, when I was thinking about how to address the topic of what we do and why it works, I was in an Apple store and I was buying a new phone. And while I was waiting for my credit card to go through, which took quite a long time because obviously the chap was worried about my use of leverage, he said, so what do you do? And I said, well, I work in private equity. And he said, well, what's that? I said, well, okay, we do buyouts. And he said, right, what's that? So I said, okay, we raise money from pension funds, we invest it in businesses, we try to make them better, and when it works, we sell them. And he said, oh, that. So now, don't you ever feel sorry for the companies that you buy out? And I thought, is that what it's come to? I thought, well, no, I don't, because I gave him a statistic. The portfolio that we have of businesses, Montagu, we have about 12 companies that we're invested in. They employ today about 16,500 people. When we bought them, they employed 14,000 people, and we've owned them for an average of 2.5 years. So we're creating about 1,000 jobs a year, well ahead of Europe or UK PLC's average rates. And as you'll see as we go through today, this is a story which is replicated across the industry. So, my case to my friend Apple was, we are good for the companies that we invest in. We are good for our investors. And this is an industry which has worked sustainably now for many years. So it seemed fitting, given that that was the reaction I got from a member of the general public, that when Jan asked me what I was going to talk about, I said, why don't we talk about private equity and how it works? And she said, that'd be really good. Jan, by the way, is here. There she is. Jan is a member of your alumni team. She said, I've got 5 contacts in the alumni department who work in private equity, and I couldn't tell you what any of them actually do. So over the course of the next half an hour, I will tell you exactly what we do. You'll leave knowing what we do, and you'll leave with my view about why it works. And you'll hear me talk a lot about this today, about alignment of interest. About alignment of interest from our investors, who are long-term pension funds, endowment institutions, and so on, through us, and I'll tell you how we're rewarded, so you'll get full visibility of the absolute mechanics of how private equity works and why we do what we do, and then how we do it, right down to the companies that we invest in. So how we motivate the people that work in those businesses, as I said, to make them better. And when it works, this is what we get. We get excellent returns. So this is a 10-year return slide, I think. And you will see overall, the whole industry, all sectors, all participants, all stages of investment, bad funds, good funds, not so great funds, we deliver overall an 8% return. The best ones, very much better than that. Now, it may surprise you to know that won't surprise you to know actually, that that's better than the FTSE, even though the FTSE went on a spectacular bull run during this period. And that the all PE 20-year return, and I don't unfortunately have the statistics for the individual sectors, so I couldn't put the 20-year numbers up, but the all PE, everybody, including all of the people that underperform, for 20 years is double digit. And that's 10% returns every year for 20 years from investing blindly across the private equity sector. So let's start with what we do. And the first thing to say about what we do is it's as old as the hills. I remember a room not dissimilar to this one, a long time ago now, 25, in fact longer, 27 years ago, my first economics lecture. And all those who've had your first economic lectures will know that you're talking about Marxian economics. And what we do is a fundamental pillar of the capitalist system, which is we allocate capital to efficient users. That, you probably know, is a picture of the Santa Maria, en route to the New World with Christopher Columbus, financed by third-party capital with a crew and leader motivated by a profit share. And the history of our industry in its current incarnation dates back to 1945. After the war, a chap called Macmillan was commissioned to explore funding for private companies. How do we kickstart the economy after the devastation of World War II? And he recommended to the government that a pool of capital was made available for private companies that didn't have access to risk capital on the public markets. And a business called ICFC was created. All the banks were shanghaied into it. The government put some money in through the Bank of England, and the Industrial and Commercial Finance Corporation that was formed in 1945 rebranded itself some 30 years later as 3i. And that is the genesis of the private equity industry in Europe. For 20 years or so, we did just that as an industry. We invested in businesses for growth, gave companies that needed risk capital for development projects that money. And the industry developed investment judgment skills to go with that. Over the course of the 70s and 80s, the conglomerates that had developed post-industrialization started to break up. They started to sell non-core businesses. And the risk capital that enabled that process to take place was provided by this industry. And the private equity industry at that point developed the techniques which gave birth to the buyout, today the biggest part of our industry. So investment judgment techniques developed for assessing projects and returns throughout the 40s, 50s and 60s. M&A skills developed during the 70s and 80s. And then in 1990, I've always had a great sense of timing, so I managed to join a risk capital industry as it hit its first experience of recession. And I joined 3i in Manchester in 1990. My first job was to look after the RALPH portfolio. And RALPH is an acronym that stands for Receiverships, Administrations, Liquidations and Failures. So yeah, a good introduction. But that time, from 92 to 2007, saw an unprecedented boom in what we did. We went on an unending bull run for about 15 years, unchecked economic growth. And that really gathered momentum for our industry, which had grown slightly ahead of inflation, if you look back at all of the data, until about 2005, when it mushroomed. And we went from a business investing about 30 billion a year in Europe to a business in 2005 to an industry investing about 130 billion in 2006-07. Today, it's back at the size it was in 2004. So we had this tremendous boom. And what that meant was, on top of the M&A skills that we'd developed to go with the investment judgment skills, prices for businesses went up. And it wasn't enough just to buy things well to get your investment judgment right. That was priced in. So we had to get good at growing businesses. We had to develop an operational skill set to go with the M&A and the investment appraisal stuff. And that, as an industry, we really got to grips with over the course of the last decade. And it's a good thing too. I mean, we learned it in the early part of the 2000s, and it meant that we actually managed to navigate 2008, 9 and 10 relatively well. So that's a potted history of how we've got to where we are. But if you want to think about us, we are really allocating capital to efficient users. And when we do this, just how do we do this? I talked to this is a slide I wish I'd had when I was waiting for my credit card to clear. But we raise money from long-term investors. It comes to us. We have complete discretion over that money. We invest in or buy businesses with it. We sell those companies. And what do we do with that? Well, we take a profit share. We give the return back to the investors. But we also support, in Europe, and in particularly in the UK, a world-leading industry that supports that activity. And to give you a feel for the scale of that, Montagu, who employs 16,500 people in our portfolio, is part of an industry in the UK, which, if you read the blurb, you will know has investments in companies that employ 1.2 million people. That's global funds coming through the UK, investing in global businesses that employ as many people as the NHS. Our 16,500 employee bit of that 1.2 million spent 250 million sterling on professional support services in the UK last year. So it gives you a feel for the scale of the activity here, for the amount of tax that's paid here to support an industry which is essentially global in nature. And we're world leaders at it. And who are those investors? Well, our investor base is global, as I've said. The investor base at Montagu is broadly representative. This isn't ours, actually. This is the industry as a whole. But it's a third US, it's a third Europe, Middle East, and it's a third Asia, broadly. And it's made up of people with a very long-term perspective. So it's pension funds, private and public sector, it's endowment plans, it's family foundations, and it's national governments through their sovereign wealth funds. And then other professional long-term investors, family offices, charities, believe it or not, and so on. So these are people with a very long-term perspective. And what do we use that money for? Well, you will have heard a lot of jargon we talk about greenfield, we talk about seed, we talk about institutional buyouts, we talk about infrastructure, but essentially you can think of us allocating capital at 3 stages. Either at the beginning of a deal, the beginning of a business's life cycle for startups, for growth capital or partial cash out to owners for investing in businesses that exist already, or at point of change of ownership. So it's startup, growth, change of ownership. That's all you really need to know. But they all have the same driver in common, which is we only succeed if we get growth. Growth in the value of the enterprise. It's clear in the case of a startup, there's nothing there. So unless you get growth, there is no value. In the case of an existing business, we invest, at the point that we invest, unless we bought very cleverly, we need to grow the value of that business. And the same is true at the point of change of ownership, because the prices that we are having to pay to compete with what is now a very efficient market in companies means that we have to deliver growth. And if you bear with me now, what I'm going to do is I'll tell you stories from my personal experience which cover 2 different ends of this spectrum. One startup, one buyout. And you'll see the common thread here. So the first one is Mason Communications. This is an investment I made when I was at 3i. It was one of the first deals that I did. We invested £160,000. It's hard to believe now. I have to say £160,000 alongside 4 people who were leaving a business called Costain. Costain is a construction business. And in the early 90s, in common with a lot of construction businesses, Costain was having a bit of a tough time. This business was a tiny little niche, turned over about £1 million, made about £150,000 profit as part of Costain. And the 4 people that ran it had ambitions to grow it quite quickly. What it did was it was a specialist in solutions for moving data around or communications around securely and in real time. So it had developed to get data from down the hole in an oil rig onshore securely and instantly. And that had applications for police forces and for utilities. They wanted wanted to develop the business with Costain. Costain didn't want to do that. They tried to buy it from Costain. Costain didn't want to do that. So they reached the conclusion that the best thing for them and the best thing for their business was to leave and start up. Now, where we came in is that they were absolutely terrified of having a dry period when they set up their business. They wanted to be properly capitalized because they wanted to be ready for the long term. So when I was talking to them about funding them, they were very clear that they didn't want a fixed commitment coming back out of the business, which is hard. If I have an exit, tying money up with no yield on it was difficult. So I reached a deal with them, which was, okay, I get that, but we do need to see some return. So we will have a profit share. And if you don't want to take your dividend, that's fine, but you must agree to pay us our share of the profits every year. And that was okay. So that they agreed. And you can see we're absolutely aligned here. They have no downside. If it doesn't work, they're not going to pay anything out. And if there's no growth, we don't make any money. So what happened? They thought they would start trading on the 1st of May. In 1st of April 1993, year end 31st of March. They decided to leave Costain and set the business up during March. We got a call during March from one of their customers that said, we're reaching the end of our budget year. We've got surplus budget. We're going to use you next year for quite a lot. Can we pay you now if you invoice us? And then we'll get the service next year. Okay. So we had to incorporate the business immediately so that we were able to receive the payment. And that was £550,000. So this business never had less in the bank than our investment plus what the team themselves put in. So it always had more than the original investment stake. At the end of the first year, our first year dividend was £140,000. So we only got our stake back within a year. And it was a tremendous success story. It went on to be sold to Dimension Data for about £30 million about 10 years later. And it was just terrific. So you can make money doing startups. And you make deep bonds if you do that. You know, I'm still friends with these people today. So 17 years later, here's something from the opposite end of my personal experience. This is a business called Host Europe. It's one of the leading web hosting businesses in Europe. You might know it from 123.com. The reason this business was for sale was it had outgrown its original founder. It had doubled its size and its profits organically pretty much every 3 years since inception. And they felt that they were running out of steam organically, that they'd reached the limits of what they could do the way they were structured. And they wanted to find a partner who was able to fund acquisition-led growth, as well as somebody who would bring the operational support that they felt they needed. So we engaged in a discussion with them. We paid quite a lot of money for the business. And to give you a feel just simply for what we did here, this was a business that was half Germany, half the UK. It was organised geographically. So on a Monday, the UK MD and the German MD would think about domain names. On a Tuesday, they would think about applications, website design, email supply. On a Wednesday, they'd think about managed hosting. That's us having their server on our site. And on Thursday, they'd think about the cloud, which is about them giving up their servers altogether and then coming on to one of our shared servers. And if one of those things worked, well, that was kind of enough. And then on Friday, they thought about growth and recruitment, running the business and doing everything else. So we sort of said, well, that's a bit daft, isn't it? Why don't you have a chief exec, keep your country oversight, but have somebody responsible for each of those product areas? And it took us about a year. It sounds very simple, doesn't it? But like all organisational change, it took a long time and quite a lot of tears to get it done. But we did. Trading was fabulous. And in the 17 years between doing this and doing Masons, we've learned how to put how we create value on a bar chart. But what you'll see here is that it had not run out of steam organically. We were able to set this business free, release yet more potential organically. And of the acquisitions, we made 4 acquisitions to increase its geographic footprint. Hardly any of the value creation came from that. Most of it was done organically. And this is a business that we bought for 220 million and sold for about 440 about 3 years later. And that is not uncommon. So I promised I would tell you about alignment. You've seen how we've aligned the interests of our managers with us in terms of delivering growth from the underlying businesses. When that comes at how are we aligned with our investors, well, this is how it works. So we raise money. In Montagu's case, our latest fund is €2.5 billion. We have complete discretion over what we do with that money. We get paid an annual fee, which enables us to do the stuff that I was talking about in terms of looking at and exploring investments, keeping the offices open, having my people on the ground. And then when we sell, so we invest all of that money, it takes us about 5 years to do it. When we sell things, we pay all of that money back to the investors. And when we have paid all of that money back, plus 8% compounding per annum for all the time that that money is outstanding, plus all the fees that we've drawn down to help us do the stuff, plus 8% on that, if there is a surplus above that level, then we share in the profits. And that is where the bulk of the private equity firm's returns come from. Technically, it's called a carried interest. What it is a profit share. But we are completely aligned with the long-term interests of our investors. And we only get our share once the investors had everything back plus 8% a year, and we only get a share out of the surplus. and it takes a long time. So if anybody's thinking about a career in private equity, you've got to be in it for the long run. And the way we motivate the people in the businesses is just like Christopher Columbus. It's a profit share, it's an equity stake in their company. And in our business, most of the deals that we do, most of the companies that we invest in, it's their first time they've come into private equity ownership. So we are taking people who are, again, in the language of the Marxian economist, labour, and giving them a share in the capital. And we have an equity participation. It really means a share in the proceeds, as do the management and often the employees of the businesses. And we do use leverage. So we do use third-party borrowings. You'll see that it differs by stage of investment, and it differs by the risk profile of each business. And where people get unstuck is where they've misunderstood the business risk and they've put the wrong financial structure on the company. And of course, we're not always right, but it's not a blanket use of leverage across the industry, and it also is not the driver of returns. It's much harder to get a job in our industry than it was when I started. So we've got a chap who works in Montagu now. His name is Ed Shuckborough. He's an absolute maths genius. And in 2008, when the banks retrenched, I asked Ed to do some work on what would happen if we could only borrow a quarter of what we borrowed before. So instead of borrowing 4 years, on average 4.5 years of cash flow, we could only borrow about a year and a half. Then he went away and he did the work, and the research, the outcome was really interesting because our returns didn't move very much. So our annual returns were affected by about 2 points. And we're a business that generates about a 20% net return for our investors. So if you'd taken that portfolio with less gearing in it, we were delivering about a 20% return instead of a 21, 22%. I thought, well, that's not material. And of course, we were making more money in absolute terms because we were having to put more of our own capital in. So I thought, well, that's interesting, Ed. Why is that? And he said, well, it's because it's a 1/1 minus x curve. So, which is exponential. So I made him draw it. And where leverage is really material on your returns is when it starts to get to the levels where we just can't countenance it. It's at 8, 9, 10 times annual cash flows. It's the kind of leverage that you see in property portfolios, not appropriate for businesses. So this is a business really, really driven by growth. Growth in the value of the companies that we own or invest in. And we use leverage for a couple of reasons. One is it stretches our acquisition firepower. So if we fund things 70, 30 or 66 and 34, clearly our 2.5 billion goes a lot further. So we can do more with that. And the second thing is that because we're not putting all of the money into a deal, it works just like buying a house. So hands up anybody who's seen this graph before. Yep. This is all you need to know about buyouts. So on the far side here, that's the structure on day one. The debt bit is borrowed from a bank. The shareholder loan is provided by us or our equivalent. And the shares, which is a small part, are owned by the management and employees of the company and by us. And depending on the size of the deal, that percentage will differ. But often, in our deals, management will have about 10 to 15% of the upside. Now, I'm often asked what happens if you lose money? What happens if the business is worth less than you paid for it when you come to exit? What if things go wrong? Well, we take the pain, and the managers take the pain. So managers are highly motivated to make sure that the plan that we back is credible. Because if they achieve the plan, we grow value. And if we grow value, they're in that green bit. And if we grow value a lot, and we pay down some of the debt, just like paying off your mortgage and the value of your house going up, they do very well, as do we. But management get a share in the business not because we're short of £100,000 or something in a £200 million buyout, but because we want them to be absolutely motivated to achieve the plan that we have. So when I say we take the pain, the businesses go on. It's basically, we have lost money, but the companies themselves will go on and often thrive with a new owner and a new financial structure. So that's it. That's buyouts. I talked about alignment, and I've shown you the financial tools, but alignment is not just wanting something to happen. You have to commit. So any athletes know that it's about commitment. It's not just about wanting an outcome. And in a business context, I think alignment gives us three things that are really important. First of all, it gives us clarity. We know where we're going. It's agreed at the outset. In this case, we are going to Leeds. And then when things go wrong, which they do, or we get an opportunity to get there quicker, we can assess how we deal with that. Do we go round it? Do we need to reappraise our objectives? Can we still make it? Can we get there quicker? And then finally, it gives us urgency, because everybody wants to grow. And in the case of a startup, it's clear you've got a chance. It's your time. You've got to grow. You've got to grow. You've got to grow before the competition get you. In a growing business, you've raised money for a project. You've got to do that project while the window for that project is there. And in the case of a buyout, you've got the leverage. You've got a plan. You've got market circumstances which will change, but which at the time you do the deal, you understand. You want to execute your plan while those conditions pertain. So it's urgent. When we talk about clarity, the objective is clear here. This is about creating value. It's about making every investment that we've got the most valuable that it can be. That's understood. Then we have a plan as to how we do it. Everybody knows what they have to do. Everybody who has a stake or a material influence over the outcome of that plan is incentivized and is very clear about their role in making that happen. And that is agreed in advance. And that means that we have no distractions. We take the fast and direct route. And anybody who has had a family business or entrepreneurial thing and please themselves, anything like that, knows that sometimes you take the scenic route. That is not an option here. And when I talk about no distractions in the context of business, I'm talking about having freedom, about everything, every decision that that management team makes has got that business's interest at heart. It's not being told by head office, this is this week's project, or today we are going to be a matrix structure, or we are going to not go through that distribution channel because it conflicts with this other part of our business, or whatever. You do what is right for your business. And you've got 100% of your focus on your business. And we don't have quarterly reporting. And we're not concerned about annual objectives. We want to do what makes this business the most valuable it can be. So you'll see, I'm going to talk to you in a second about a business called Cap, which is about half a mile down the road, about us investing in long-term growth, which actually would be very, very difficult to explain to a set of investors who were measured quarterly. We talked about adaptability. Life is, the Spanish have a phrase, life is long and there are many opportunities, and that's true, but you need focus. So where are you going? If you've got the context of clarity, you can decide which acquisitions we're going to do. Is it consistent with what this business actually does? Or if we did that acquisition, we have to go and do something else. What contracts do we take on? How do we sell? Do we sell today for a license for our software that brings in the most income? Or do we sell an annual recurring fee on a 10-year contract, which gives us security over the longer term and a longer term better business when we come to sell it in 5, 6, 7 years' time? And we talked about problems and whether or not we have to change what we're doing. You probably can't read that bottom graphic. It says, it's a GPS sim, it says, new route found, 8 minutes faster, do you want to take it? And we have a phrase which is that 80 is better than naught. What does that mean? Of course it's better than naught. But this is about not letting the perfect be the enemy of the good. So if you have a business, imagine you're running a business. You might make profits in our scale 10 million a year. And there might be an opportunity through better purchasing of your components to save $500,000 a year. But to do that, you need to recruit somebody to carry out the study, to do the work, to negotiate with the new suppliers. You've got to recruit that, but it takes 2 years. A year to find the right person, a year for them to do the work. They're costing you $150,000 a year, so you're behind. And at the end of that, you might make $500,000 better purchasing in 5 years' time, net of the $150,000 a year, net of less all the people costs that you've had in the interim. But we'll sit there and say, well, we're repeat buyers of this. We've got a portfolio of businesses. We've got, since 1968, experience of doing this across many businesses. And we may not get the $500,000, but we'll get 80% of it. And we'll do it now. And then you multiply that across multiple projects. And we are really about accelerating businesses. And that is how we do it. That's urgency at work. So how do we get from this model, which, as you can tell, I think is unashamedly a great thing, to this? Well, a couple of things, really. I think that urgency doesn't always make us popular. And secondly, we're very private. Because we don't have quarterly or annual reporting, this is a business, as I said, that employs as many people through the UK as the NHS. It's quite big, this material, and nobody knows much about it. Witness the Apple chap that I talked about at the beginning. So something that's big, powerful, quite secret, and urgent is going to generate headlines. And the interesting thing about this is that I think all these things are 180 degrees wrong. So to translate them into English, not about creating jobs, it's about financial structures. Well, this is basically a leveraged play on the FTSE. Well, it's not right. There have been quite a few studies, some of them, of course, by the industry, but the BVCA study, Nick Wilson, who is a professor in the business school. Anybody know Nick? Yeah? He's a great guy. He did some research on employment, and you'll see we outperform the story I told you about Montagu, 14 on acquisition, nearly 17,000 today. That's replicated across the industry. We created 1 million net new jobs in the first part of this millennium. And in Yorkshire, this is Montagu's portfolio in Yorkshire. We have 1,500 people employed in the businesses that we own in Yorkshire when we bought them, over 2,000 today. And you hear a lot about buyouts. Buyouts by amount of money is the biggest part of our sector. It's also most glamorous. It deals with the names that you all know. But the bulk of our activity is in things like Mason. It's mostly early stage and small expansion stuff. It's an industry really focused by activity on creating, which is the opposite of this headline. This is a very excitable German politician who described us as irresponsible locust swarms and provoked a real bout of introspection in the private equity industry. We still have, in a SWOT analysis of where we are today, the locust debate. But the idea that we can find inefficient balance sheets, buy them, sell off, break up businesses, and pocket the difference is like unbelievably wrong. I mean, I wish it were as easy. But the average price paid for a business today by a private equity business is 9.6 times what a friend of mine from one of my investments used to describe as profit before costs. This is earnings before interest and tax, depreciation and amortization. So the actual free cash flows before you invest in your business. 10 years worth we've paid. So growth is an imperative. It's not optional. We're not going to get arbitrage for buying at 10. We are buying and selling at the same prices if we are lucky. And this is why we've become good at growth. This is 5 years to 2012, 7% a year when the economy did nothing. And that's including all of the bad investors, This is the industry-wide. And nearly half of us make follow-on acquisitions. In our case, it's almost all of our companies. Only 10% make disposals. Which brings me, I talked about Cap. This is a business which is about a mile down the road. It does automotive data. That picture at the top is a Capcode. So if you have a car, it's got a Capcode. And that code tells you what it is, what its engine capacity is, what colour it is, what wheels it's got, what trim it has. And why is that important? because if this part of the room is a car leasing business and this part of the room are car dealers that want to buy from those leasing companies, and this part of the room is an auction site, you don't have the same IT, but you need to know what you're dealing with. And you need to know what, so you use the Capcode. And you subscribe to the Capcode if you want to participate in the UK used car industry in any way that's material. So it's a license-based revenue. Absolutely fantastic business. When we bought it from a cash-strapped conglomerate, EMAP, who had used that Capcode to fund all sorts of other stuff because they had the wrong financial structure for their business. And we brought it out. We paid a lot of money. In fact, we paid about 14 years of cash flows for Cap. And the only way we can make money from that is to grow it. So we took a business that employed fewer than 100 people. We've recruited someone into that business every week since we've owned it. It's growing double digit. It's launched 2 new product suites. It's a fantastic local success story. And again, we're just financial engineers taking a ride. Well, as I've said, it's 1 over 1 minus x curve, and we're nowhere near the end. And this is Nick's work, which I thought was really interesting, because if we borrow, clearly we have to pay interest on that. So if we don't grow the value of the businesses, all we've done is pay interest out. So the impact of leverage on us, if we don't grow value, is negative. The second point is fascinating in that it doesn't increase the risk. So the rates of failure of PE-backed buyouts are lower than non-private equity-backed buyouts. This was true even during the recession. So what this tells me is that while we impose financial risk on situations, we impose a compensating and net beneficial operating set of circumstances through incentivization and operational support that cancel out that effect. And Ernst & Young did some work saying, let's take the stock market return over a period, 2005 to 12. Let's look at the leverage effect, assuming you use the same degree of leverage to fund your acquisition of stocks in the FTSE. And that would have made you 2.5 times a straight all equity investment on the FTSE. And we made another 1.5 because we're good. And then private equity funds are barely worth it. Well, you saw this at the beginning of the talk. If it's worth saying once, it's worth saying again. So I've used my time up, but we talked about the scale of the industry, same size as the NHS, just in the UK. If you've come here via Leeds Bradford Airport, if you've eaten a sandwich from Pret-a-Manger, taken a loved one to Pizza Express, bought some plasters from Boots, wearing clothes from New Look or Hugo Boss, or you've taken cash out of a cash point today, done any of those things, you've touched private equity. So it's a material business that bears understanding. And where do I think we are today? Well, I think we've shown that we can adapt. I think we are very well placed. I think our challenges are that we don't make, we haven't made enough money out of new ventures. So we need to make that work. And I don't think that enough people understand it. So if you look at what I think the dangers are that are specific to private equity as opposed to just the general economy, I think there is a danger that we get lumped in with the financial systemic risk through derivatives and so on, and then we get regulation which is inappropriate. But actually, I really don't think that's going to happen. I think the BVC and the European Venture Capital Association are doing a good job there. But that's it. So I'll leave that up because it's a pretty slide. But if anybody's got any questions, I'm, of course, at your disposal.